Hello, this is Tradesight's market index preview and roadmap for the week beginning Monday, January 28th and ending Friday. February 1st. We're going into February already, 2013. This is for stocks and futures primarily. Here's a look at the S&P, and this is what it looked like. This is the S&P 500 index on the daily chart, and this is what it looked like exactly a week ago today when we did this preview of the market for the week. And if you recall, what I pointed out at the time was that here was a Comer 13 sell signal, and this pink line that forms is the risk line. And if you know how to use the Comer tool, what it means is that you're looking at a potential stop out point in the market, a potential rolling over point, but the risk level is if we get back above that level, or if we get above that level, okay, then that's sort of your stop out point. So if you did anything to the short side here in preparation for a roll, if you move above that pink line, that's your stop out point. What's important about that line that we teach is that if it breaks fairly quickly, it usually leads to a fairly good move the other direction, to the upside in this case. And I had pointed out that there was a real battle here in the market because you've got a 13 Comer sell signal, but you've also got a very nice constructive, almost cup long 4 or 5 month breakout formation in the market that's really constructive. And so what's going to win, the Comer sell signal or the general construction of the market? And I have to tell you, as I said, usually I go for the construction when it's this long and this solid over the signals themselves. But what's nice is when you use the Comer, it's okay because you get the 13, and now I know that if I break out, not only am I breaking out on the chart, but I'm breaking through that risk line. I'm doing it soon after it started forming. That often leads to a move. And I just want to point out, this is what we did this week. Now this is on the broad S&P, but this is what we did this week. Okay. And by the way, we get another 9-bar setup now complete to the upside. But this is the week in the market. Okay. So again, that's something that you can see not at this point, not just because the construction that should have led to that move, but the minute you broke that risk line, you should have expected that there was more and fairly quick upside movement to come in the S&P. Now let's take a look at the NDX, where we're not in the same boat at all. And again, Apple, in this particular case, Apple's earnings really put a damper on the NDX this week. And you see what's happened is we did start to head up, but look at what this this little bar is up. Okay, here we were 11 into the Comer count, so another 2 new highs, and we'll be at a 13 sell signal up here. But more importantly, look at this. This is an island reversal formation. Okay, this is not good for the Nasdaq side. I'll tell you that right now. This means that you had a day where you gapped up, held the ground. Next day gap down. That means all the buyers from that day are trapped. And when you do that after a decent move up, and I would argue that since the middle of November we've been on a decent move up, when you do that, a floating island at the top of a decent move is usually a pretty strong sell signal. We may not get to the 12 and 13 anytime soon on this. It'll be interesting to see how this plays out. Remember, we saw a lot of stocks perform very well this week with earnings. Netflix obviously took off, Amazon took off, and Google did well, but you know, Apple obviously currently the biggest weight in the market, biggest weighted stock in the market. So it's playing a role there when it comes in with such bad numbers. So it's going to be interesting to see what this means for the market. So far, the S&P has been very strong. The broad market has been strong. The Nasdaq side not nearly as strong. A lot of it just because of Apple. We've seen a lot of stocks making great moves. But let's be aware of a couple things. Let's be aware of that floating island because that's a very strong signal when you get those. It looks like nothing. It looks like a blip, but it's often a very important signal in the market. Let's be aware of the fact that even if we do make new highs on this, and that would negate the floating island, the next bar that's a high over the island itself will be a 12, and the 13 would be the one after for the Comer. So we get a sell signal. And on the Nasdaq side, we're nowhere near new highs. So let's also take a quick look at sorry, that's the wrong index. Let's take a quick look at the SOX, which is the semiconductors. Obviously, they look much stronger, and you can see they broke through a risk line as well, just like the S&P did. They've got a nice cup. There's some construction there. Let's take a look at the biotech index. Okay, another what's typically a leader. And this one here, I mean, take a look at this. The 13 so far is the top, and there is a risk line up there. But this is some nice constructive cup and handle formation. So, you know, the S&P looks good, the SOX looks good, the biotechs look good. It's just the Nasdaq side as a whole that doesn't look good. And let's take a look at this Apple chart. I know everybody wants to talk about this because it's been a rough sell-off for Apple since 700 now. When we were back, I'll be honest, I wrote an article for a website back when the stock was around 560, right over in here last May. and it said it was my opinion that there was a significant and key gap on the stock back at 420. And somebody said to me, well, do you think it would get maybe as high as 700 before it got back to 420? And I said no, I didn't think it could get to 700. I thought the gap needed to fill first. Now here's the irony: it got exactly to 700. It didn't go any higher. So if they had said 710, I would have been right. But it did get up to 700 back in September. But you can see since then it's been on a sharp sell-off. And keep in mind, you're talking about 40% on a stock like this. This was this is the most heavily capitalized stock in the market. It was a big deal when it was making those highs. Obviously, it's been crushed from a market cap perspective. And for people who are Apple fans, I just have to tell you now, I'm sorry, but stocks don't just come back from these types of things. This isn't something where people sit around and think, oh, now Apple's finally at good value. There is something significantly broken here. There's a lot of people out of this stock now. The funds are, it's been put into retail hands perhaps. And I'm widening the chart here because I want to show you a couple of things. First of all, here's the gap I was talking about. Okay, there's certain types of gaps just from years of experience are more meaningful to me, and this gap's at about $420.50 right here. It's this blue line, and I mentioned it again before earnings came out the other day. People thought it was crazy, but I've been talking about this since last May. We're within 20 points now. Now that doesn't mean the gap's filled. I still think we're going to get there. I don't even think that's the bottom, though. There's no reason to think that's the bottom on Apple at this point. There's obviously a lot wrong here, and there's a lot weighted. Look at the sell-off. Look at the volume the last 2 days. Now, this was the other thing I tried to point out to people last year, and the reason that I had said some of what I did about that gap even back in last summer. Take a look at the volume last February, March, and April. This is when the iPad 3 was announced. Big deal, running up to here, and then it sold off. But compare that to the volume previously. And Apple was a big stock even the prior year. We've been trading Apple regularly for years now. It's been a favorite of investors for a while. But look at how much that volume went up right around that whole iPad 3 announcement and everything. And that's again before the iPhone 5 and the new improved iPad 28 or whatever they announced in August and September, already replacing the iPad 3 that was only 6 months old. If you get my tone here, I think that at some point in time you're starting to tick off the people that like you when you're replacing their product every 6 months on them that they're spending good money on. But having said that, the volume that was in place up in here and even continued even over the summer, the volume was better than it had been prior on Apple. This type of volume increase after a stock that's had this type of move and has already been a favorite for years, this isn't usually good volume, to be honest, and you can see a lot of it was to the downside. This is some of the inside funds, and I'm not talking about retail funds because obviously the public still likes to own Apple. I'm talking about some of the bigger funds that are more inside Wall Street type of people getting out of the stock, and as they do that, there's less chance that the stock's going to continue because there's not going to be that sort of institutional support. You hate to say that, to put it a different way, the people that really can make things happen in the market have moved on. They've gotten what they wanted out of Apple, and they're no longer in the stock. And so at some point in time, that leads to these types of sell-offs, these bubble sell-offs that you get. And when you do that, you're going to focus on this gap. So again, 420 I think is a key gap. There's technically a gap lower down here near I want to say about 365. It's this blue line down here. Okay, there's still a gap there, but this one I thought was more significant because it was kind of as big as it was. You can see that if I go through and click off a few points here on the chart, you can see that a lot of gaps, when they're decent sized gaps, come back and fill. There was one right there that filled. Then we gap up here. There was a gap left behind right here that filled. There was a gap right here again that filled. Okay, it came back and filled exactly. Actually, this gap came back and filled. And remember, it's always the gaps that you leave behind below that are far more significant because it's easier for a stock to go up than it is to head down. So, for example, if I take all these lines off the chart right now and just get everything cleaned out, I could sit here and point out to you the fact that there's technically a gap back up at 700. Okay, right up here. I don't consider that meaningful. And there's a lot of gaps that we've now left behind here and all the way along. I don't consider that nearly as meaningful. It's a lot harder for stocks to go up than it is for them to go down. When you've got all of these people that bought these stocks out of institutional hands and put them in the retail public hands here, okay, the public's buried now. That's the thing you have to understand about this. The public's buried. This isn't a stock that's going to come roaring back. I know that a lot of people don't want to hear that about Apple, but I tell you this, I've been trading now for over 20 years, and it's just a fact at this point, and we've been talking about it and predicting it for a while. But again, I think this 420 is in play. That's really not much of a move at this point to even say that. I saw somebody on after the earnings came out said that they felt like this is now that the stock's at 450 from 700. They felt like the stock could hit 420 this year. Yeah, in an hour. Okay, we're almost there. It really doesn't matter. At this point in time, there is some panic selling occurring. This is retail. Now, these are all the poor retail guys that got in all the way up in here, getting margin called out or just panic flushed out. They're losing too much. So yeah, that's why you're seeing the heaviest volume ever. They're pushing it back into somebody's hands. But do not think for a minute that that means that those people are going to grab that stock back up and run it back up again. You know, Apple's going to go up and down. You know, from a technical perspective, this gap needs to fill. But you know, this is not a stock that's just going to turn around and run back to new highs after this type of pattern. It just is not. All right, let's take a look at the roadmap for the week on the stock. All right, this is some of the data that's due out this week on Monday. We've got durable orders. That's not a big deal, nothing to be too concerned about. We are past the core 8 days of earnings, so we have that behind us. We do not have options expiration this week. We do not have a holiday coming up anytime soon. I believe the next holiday is President's Day. It's a month away, or three weeks away maybe, on a Monday. So, or yes, on a Monday. So we're pretty wide open until the next options expiration and the next holiday. So it should be just straight trading. Again, most of the core earnings are behind us. We don't have that to worry about. So Monday, again, durable orders, not a big deal to the stock market. Tuesday, consumer confidence, that can be a big deal. It's 30 minutes in. We'll be definitely watching that number. The overall estimate is 65.1. Briefing, as you can see, expecting lower than that. On Wednesday, we've got the ADP employment change data, mortgage index, but this is the big one right here. Two things coming on Wednesday. Number one, first look at gross domestic product for the fourth quarter. Okay, some pretty big ranges here, and annualized 1% coming out of the overall consensus. You know, that's obviously down from the some of the earlier quarters of last year. But again, that's a big number. That only comes out once a quarter. It's the first look. That's the one that matters at GDP for the fourth quarter. We've also got a 2-day Fed meeting and the rate announcement coming at 2:15 p.m. Eastern Time on Wednesday. So two big things on Wednesday. That's going to be the key day of the week, the thing that the market's going to focus on. When you get to Thursday, you've got the usual initial and continuing jobless claims. You've got personal income and spending, PC prices, employment cost index. Chicago PMI can move the market if it misses or beats by quite a bit. And then on Friday, the other key thing the market's going to focus on, amongst a lot of data actually on Friday, is the unemployment rate, the non-farm payroll data. Market looking for 180,000 jobs, 193,000 of them private sector, which means a loss of jobs overall in terms of new jobs out of the public sector. So again, we're seeing a shrinkage of public sector jobs over the last couple of years. Some of the smallest federal government employment rates we've seen in decades, which is often part of what brings the economy back is government jobs, but they've not been created for a variety of reasons. So it's all in the private sector to do it this time. We've got Michigan sentiment final coming out at 9:55 in the morning on Friday. We've got ISM index and construction spending. It's a lot of data right there. So a big pile to look at Friday morning. So again, we've got the focus of the week will be the GDP number, Fed announcement, which of course probably nothing new there, and then the NFP data on Friday. That's your roadmap. Again, I would think that Thursday is probably the better trading day of the week. We know how Fed meeting days go, but there might be a reaction Wednesday to that GDP number as well. Everyone have a great trading week.